Welcome to this explainer. If you've been paying any attention to the markets lately, you know things are shifting. And the Oracle of Omaha? Well, he's been making some genuinely historic adjustments. Today, we're cutting through the noise. We're looking strictly at the data, the source letters, and the concrete actions Berkshire Hathaway has taken as we enter a totally new era for the company. Let's get right into it. All right, let's talk about the elephant in the room. $300 billion. That is the historic, record-breaking cash hoard sitting at Berkshire Hathaway in 2026. I mean, it's an absolutely astronomical figure, and it's left a lot of folks on Wall Street scratching their heads. Why on earth is the world's most famous investor sitting on a mountain of cash while everyone else is frantically chasing the latest market trends? To understand this defensive posture, we really need to dig into the core philosophy behind it.
Here's our agenda for today. First, the Oracle's investing playbook. 2, moats and margins of safety. 3, decoding the 2026 portfolio. 4, the $300 billion cash hoard. 5, the index fund secret. And finally, number 6, a legacy beyond Warren Buffett.
Starting with Section 1, the Oracle's investing playbook, building a $1 trillion empire. So we have to start by laying the foundation. We're talking about a strategy that took a struggling northern textile business back in 1965 and turned it into a $1 trillion fortress. Be fearful when others are greedy and greedy only when others are fearful. This captures Buffett's contrarian nature perfectly. He coined this back in his 1986 shareholder letter. And you know, it's not just some catchy bumper sticker. It's his operational heartbeat. While everyday investors and big institutions fall victim to the hype, Buffett methodically does the exact opposite. Because what he's actually looking for is true intrinsic value. He treats stocks as real ownership in a real business. They aren't lottery tickets. He honestly doesn't care about day-to-day market volatility or macroeconomic guessing games. He cares about calculable worth. If you buy a stock, you're buying a piece of a business. So you have to understand exactly how it makes money and what its future cash flows realistically look like. And this entire philosophy builds directly on Benjamin Graham's teachings. This anchors Buffett's modern moves to a strategy that's been proven over half a century. Buffett famously credits his intellectual origin to Graham and Doddsville. It's not about guessing what the market will do on a random Tuesday. It's about ruthlessly exploiting the gap between a market price and the actual underlying intrinsic value of the business.
Moving on to Section 2, Moats and Margins of Safety, Protecting the Castle.
You see, finding value is really only half the battle. Protecting it, that's where the real compounding happens. You need companies that will still absolutely dominate their industries 20 years down the road. Enter the economic moat. Whether it's the massive brand power of a company like Coca-Cola or huge cost advantages from global scale, a moat ensures that a business's intrinsic value actually grows over time, rather than getting chipped away by competitors. If the moat isn't durable, it simply doesn't make it into the playbook. This leads us to another historic Graham and Doddsville concept, the margin of safety. Think of it kind of like a bridge. If you're building a bridge that needs to hold a 10,000-pound truck, you don't build it to hold exactly 10,000 pounds. You build it to hold 30,000 pounds. Investing is exactly the same. You have to demand a massive margin of safety in your purchase price because, let's face it, you will occasionally be wrong and the market will occasionally be irrational. But remember, Buffett's strategy evolved. Working alongside the late Charlie Munger, he learned to prioritize quality over deep discounts. Benjamin Graham initially looked for statistically cheap cigar butts, but Munger taught Buffett that it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. The real magic happens when a truly wonderful business compounds at high rates over a timeline of decades.
Section 3. Decoding the 2026 portfolio. The Apple and Bank of America trims.
All right, with those theories in mind, let's look at his recent actions, the ones that have sent absolute shockwaves through the financial world. This contrast perfectly illustrates his valuation discipline. Buffett loved Apple when it was trading at a forward PE below 15. He was getting a cheap price relative to expected earnings. But he smartly took profits when those soaring expectations pushed the multiple past 33. Apple had grown to be nearly half of his equity portfolio, but hey, no position is permanent if the price stops making sense. A multiple above 33, price is in perfection, so taking profits here is just textbook execution. Never overpay for assets. And what's fascinating is that while everyone else was frantically chasing the next AI tech rocket, Buffett quietly flew in the exact opposite direction. He selectively deployed capital into Japanese trading houses, Itochu, Marubeni, Mitsubishi, Mitsui, and Sumitomo. He went looking for understandable businesses with honest management, reliable dividends, and geographic diversification, all trading at really attractive valuations. It is just classic Buffett. Which brings us to Section 4, the $300 billion cash hoard, patience as a strategy. So let's get back to that massive pile of money sitting on Berkshire's balance sheet in 2026. It's only when the tide goes out that you learn who's been swimming naked. This famous quip reminds us that market downturns eventually expose the reckless. He originally used this phrase to describe inadequate reinsurance after Hurricane Andrew, but it applies perfectly to broad market valuations today. Right now, high prices mean the tide is high. But Buffett knows the tide always goes out eventually, and he'd rather keep his powder dry than force capital into overpriced assets. Because that cash isn't just sitting idle. It is a strategic stockpile of optionality. It's ready to be deployed into exceptional assets when the next crisis inevitably hits. Sure, sitting on cash carries an opportunity cost during a raging bull market, but Berkshire's sheer scale requires massive capital deployment to actually move the needle. By waiting, Buffett maintains the ultimate margin of safety. When a dislocation happens, he becomes the buyer of last resort, dictating terms and snapping up wonderful companies at truly wonderful prices. Now for Section 5, the Index Fund Secret, advice for the everyday investor. So what does this billionaire strategy actually mean for us? For your own money? Most of us aren't managing hundreds of billions of dollars or negotiating preferred stock warrants. Well, surprisingly, his most consistent advice for the retail investor is to avoid active management entirely, dodge those high fees, and simply buy the whole market. He points out that active managers as a group are mathematically guaranteed to underperform passive indexers over time. Why? Because of the staggering drag of their fees. Just look at the specific instructions for his wife's trust. This is a man worth billions, and his estate plan doesn't involve complex hedge funds or exotic private equity. It's shockingly simple. Put 10% in short-term government bonds and put 90% in a very low-cost S&P 500 index fund. That's it. It's the ultimate testament to his belief that ignoring the noise, keeping your costs microscopic, and letting compounding do the heavy lifting is the most reliable path to wealth.
Finally, Section 6, a legacy beyond Warren Buffett. Enter Greg Abel.
Let's look ahead at the future of Berkshire Hathaway as Greg Abel officially takes the reins in 2026. This is a massive transition for the financial world. But remember, Buffett hasn't just been picking stocks for 60 years. He's methodically transformed a dying textile mill into a resilient institution built specifically to outlast him. And by trimming those massive Apple and Bank of America positions now, Buffett is actually handing his successor a completely clean slate. Abel inherits unparalleled cash flexibility. He can navigate the future without being anchored to outdated portfolio concentrations.
This proves a really vital point. The value approach is not dependent on one single genius. It relies on a repeatable, disciplined system rooted in Graham and Doddsville. The principles we've covered today, intrinsic value, economic moats, margins of safety, and just unwavering patience, they work regardless of who happens to be sitting in the CEO chair. Berkshire's culture of long-term, rational thinking is structurally embedded in the company's DNA.
Ultimately, the goal is to ignore the day-to-day market noise. Stick to what you know, your circle of competence, and patiently prepare for those rare moments of massive opportunity. The market will inevitably experience severe panic again. And as Buffett says, when downpours of that sort occur, it's imperative that we rush outdoors carrying wash tubs, not teaspoons. When the skies open up and it rains gold, the disciplined investor has to be ready to act with total conviction. To wrap up this explainer, I want to leave you with a final thought about your own portfolio. While the rest of the market chases the next big trend, are you prepared with a wash tub for when it rains gold? Thank you so much for joining me for this analysis of Warren Buffett's enduring masterclass. Remember to keep your fees low, stay within your circle of competence, and never stop learning.